Welcome to the latest In Conversation. I am Pierre Braun, and joining me today is Sivapalan. Fixed income investors are witnessing the end of the monetary policy cycle. Central banks have raised rates and reduced the size of their balance sheets in order to fight off inflation. However, this has caused volatility across the fixed income markets. Thank you, Jay, for joining us. Put simply, what inflation means for fixed income.
Thanks, Pierre. Obviously, for investors, maintaining the purchasing power of their hard-earned savings is really critical across a diversified portfolio. Now, the main way that investors achieve that through growth assets, but fixed income can also play a role. In particular, when we buy bonds that are providing a real yield, in other words, after accounting for inflation, that is above zero. So in other words, we're able to invest clients' monies in assets that are comfortably beating inflation.
What's your view on inflation-linked bonds? Are they attractive at the moment?
Inflation-linked bonds have a really good role to play for client portfolios, especially when the price of inflation, so that is the price of inflation protection, is relatively low. So to give you an example from a couple of years ago, during the height of the COVID pandemic, break-even inflation, so that is the market's assumption on the inflation for the next decade, got right down to about 0.1%. So in other words, investors were being paid to take inflation protection. And so we've been purchasing inflation-linked bonds in the portfolio of the last 2 years, which has worked really well, given what's happened with inflation of more recent times. Now, if we fast forward to today, the break-even inflation that I mentioned is about 2.1 to 2.2%. So just inside the RBA target band. So we would assess today that they are still relatively cheap, but not as cheap as they were 2 years ago. And so the way we express that in client portfolios is by reducing the size of the allocation, but still worthy of some allocation in defensive portfolios.
Why has active management been so difficult for fixed income manager in the last 12 months?
I think it's fair to say that the phenomenal support that both central banks and governments from a fiscal policy side provided the economy in the last couple of years to get through the pandemic. So if you think about how low cash rates got in various parts of the world, here in Australia, 0.1%, but of course in Europe, negative interest rates, and then terms like quantitative easing and other programs really supported asset classes. Now, of course, the economy, both here in Australia and abroad, are now strong enough to stand on their own 2 feet, and therefore that support is no longer necessary, and the central bank and governments are withdrawing some of that policy support. And so that's been a challenging environment for all asset classes, whether you look at share markets here and abroad, fixed interest markets, property markets, infrastructure, and so on. Specifically within fixed income, we know that bond yields have risen quite sharply, and that is traditionally bad for fixed interest investors. Just by way of example, the main benchmark that we use here in Australia, or the index for fixed interest investments, has fallen something like 13% this calendar year. So a very challenging time. Now, what's driven that? Firstly, those bond yields rising, but also what we call credit spreads. So the price of credit risk has risen because we are now facing a much more challenging environment looking forward. And that's what's really driven fixed interest returns. But within that, we have found that some active managers have really struggled in terms of the performance, both in terms of the market return as well as their ability to add value. For our part, we've been quite defensively positioned in the last 12 months and increasingly so in the last 6 months. And we've been able to maintain and preserve capital quite a bit. So our strategies have fallen by materially less and also positioned with higher yields looking forward.
What is your view on the hybrid market?
It's really important to understand for investors exactly where those securities sit in the capital structure. So as a bond investor, we look at bonds all the way from the very top of the capital stack, which is senior secured bonds, then senior unsecured bonds, then subordinated bonds, then what we call tier 1 capital, which is effectively hybrids, and then of course you've got shareholder equity. So hybrids from time to time can be a good investment, especially when the fundamentals are improving for the banking system and the pricing is very attractive. So some of those examples are around the GFC, around COVID, around the European sovereign debt crisis and so on. Today, however, we find that in particular Australian major bank hybrids, whilst they're still relatively safe, are not valued as attractively as, say, for example, subordinated debt, which sits higher up in the capital structure. So as a professional investor, we've got the option to move from one type of security to another. And today, our preference is to be higher up in the capital structure.
Could you talk about your current portfolio positioning? Is there any changes, worth highlighting?
So the portfolio that we are managing today looks starkly different to the one that we're running during the COVID period and during the early stages of the recovery period from COVID. Because as we touched on earlier, we are now in a rising rate environment. Central banks want to normalise policy and go beyond normalising policy. And inflation, at least for now, is quite challenging for investors. So we need to position portfolios quite differently. So what are we focusing on? Firstly, we expect that the economic growth next year will be lower than this year. So we need to focus more on those sleep easy at night names, the non-discretionary retailing like Coles and Woolworths, all of your financial core infrastructure like our major banks, some of the other non-discretionary parts of the market. But also some of those industries and sectors that participate really well in an inflationary environment. So if you sort of think about the cash flows that are generated through toll roads, seaports, so Port of Melbourne, Port of Brisbane and so on, these are fantastic assets to own when inflation's a little bit higher because they're contractually participating in that upward inflation. And then lastly, the areas that we continue to like are those areas that will perform well because they were hit more disproportionately during the downturn. And that is airports, our universities. University enrolments are up very sharply for next year for Australia. And so we're very much looking forward to welcoming those students from abroad. And on the flip side, in a rising rate environment, the areas that we're much more cautious about are lower quality residential mortgage-backed securities. Obviously, the cheap money flowed right across our nation, and there are some who borrowed money that perhaps can't afford to repay or repay as well, especially in a rising rate environment and a higher rate environment. And then lastly, property construction. I think that's an area that is going to struggle for a little while, and it's something that we should avoid for the moment.
What's your market outlook and where do you find opportunities in the fixed income market at the moment?
Yeah, the greatest opportunity today is the fact that investors can enjoy healthy yields from high quality, relatively defensive fixed interest portfolios. So just to give you an example, about a year ago, high quality portfolios were providing a yield of not much greater than 1 to 1.5%. Today, those same portfolios with very similar assets are providing 4.5 to 5% yield. So that's the biggest opportunity that we see. And on the back of that, with the outlook that I mentioned earlier, a slower growth environment for next year, what we really want to be focusing on and taking bigger positions in are the safer end of the assets rather than chasing the low yielding or the lower quality assets that many investors were chasing when interest rates and cash rates were at zero.
Thank you for joining us, and thank you, Jay, for sharing your insights. If you would like to learn more, please reach out to a Pitcher Partners advisor. Thank you.